Welcome to the Wealth Stream Podcast. The team at Hightower Great Lakes share their insights and passions for empowering their clients to live their best life. In this energetic podcast, we will take you on a journey to help you navigate your financial future, overcome life's challenges to reach your financial goals, and find the financial clarity you've been searching for. Let's explore the downstream impact of your wealth and what it means to you, your family, and your community to live greater.
Hello and welcome to the Wealth Stream with Tim Scannell from Hightower Great Lakes. Today, I know that this podcast specifically is going to be rushed into your hands. I'm talking to the audience here. We're going to rush this out to you because it is very, very timely, and Tim has a lot to cover today. So good morning, Tim. How are you?
I'm doing great, and I'm ready to go. How about yourself?
Oh, the new year, and it's fantastic. And I know that this is something that you want to get out very, very quickly because it's about the Secure Act. And I'm going to let you just introduce it, run with it, and let's get into it.
Okay, so it's an important topic because when we provide what we call advanced planning to our clients, we break it into 4 categories. We talk about wealth enhancement, and that is, maximizing your cash flow, making sure you're mitigating or reducing paying the minimum amount of taxes, looking at your debt structure. The second category is wealth transfer. We always want to make sure that when you're transferring wealth, ultimately, it's going to be timely, it's going to be efficient, it's not going to be held up, it's going to be very tax efficient. Wealth protection is the third area, making sure that assets are protected. And charitable giving is the fourth, and the fourth area of advanced planning, and that really addresses making sure that, if you have charitable intent, which a lot of my clients do, that it's impactful. And I mention this because while we are all maybe shopping for Christmas gifts or wrapping presents or maybe watching the impeachment hearings, Congress passed a budget on December 20th. And the budget included something called the Secure Act, and the Secure Act impacts all 4 of those areas. So I just wanted to, get this out because we are going to go through the process in the first quarter and into 2020, having to basically re-stress test or, re-evaluate all the plans we have in place because this act really significantly impacts a lot of the planning we've done in the past.
Yeah, I mean, they changed the rules of the game, so therefore taking all your clients through a new stress test is incredibly important, I would assume, because if things change, different stress points in somebody's plan could be problematic, and so this allows you to address it very quickly. Exactly.
And Eric, do you know how I know it's really important to my clients? Because I actually had 2 clients call me about it today.
Well, there you go.
And one called and said, hey, I was over the holidays with family and we're sitting around the table and we were talking about the Secure Act. I'm like, really? You weren't playing games or puzzles or something? But so it's just interesting. So it must be, the topic is out there. I know we've been digesting it and figuring out how to respond to it. But I know it's important because clients are telling me it is too.
Yeah, absolutely. Yeah, it's like that game of life, with the little cars and little plastic people. All of a sudden you pull one of the cards or whatever and it says, Congress passes Secure Act. Oh, well, what does that mean? So
exactly.
That changes the whole board game. So yeah, no, it makes a lot of sense.
So one of the main items that they addressed or they changed is something that in the industry we call the stretch IRA. And literally, since I've been a certified financial planner back in 1986, this has been kind of a go-to technique. So it's been around for a long time. And, what you're trying to do is, if something happens to me, I want to make sure that my wife, Nancy, is the primary beneficiary. She can roll the assets over tax-free. And under the old plan before the Secure Act, I had listed my 5 kids as the contingent beneficiary. And what happens is then, when we're both gone, 5 inherited IRAs are set up, one for each of the kids. And in the past, they would be able to take that money out over their lifetime. So if you have my one daughter's 32, her, according to the IRS, her life expectancy is out to age 80. She could literally defer and postpone and withdraw that money over a 30, 40, 50-year period and continue to invest the money, get tax deferral on the money, et cetera. So the stretch IRA was really a way for our clients, myself, people to stretch out that benefit of tax deferral and postpone taxes and when the money comes out. And that's basically how it had always been done under the old rules. And so what changed really was they made a number of different classifications of beneficiaries, but without getting too deep into the weeds, what has changed primarily is that now pretty much everyone has to withdraw that money over a 10-year period. So for example, in the illustration I just gave you where, Nancy and I, we're gone, we're off the earth at some point in the future, the kids set up the inherited IRA. Instead of postponing and rolling it out over their life expectancy, they're going to be required to take the money out and pay taxes in the first 10 years after they receive it, after we pass on, after we're both gone. Mm-hmm. So it requires that we relook at all the ways we're having people accumulate wealth. And what happens is when you retire, we typically look at different buckets. We look at, okay, you've got a retirement bucket of money. You have a non-qualified or investment portfolio bucket of money. You've got checking savings. And then we work from a tax standpoint to say which ones to make the most sense to withdraw first, knowing that we're looking at this in a long-term generational planning perspective. And so in the past, where we might have had people continue to accumulate the retirement account and use their other money, or vice versa, just depending on the client's situation, this is forcing us to reevaluate everything with this new change and pretty much the elimination, in most cases, of the stretch IRA.
Yeah. I mean, that's going to make a huge difference over those next 10 years, right? For your children or your grandchildren, whoever's inheriting this money.
Right.
That's going to alter a lot.
Exactly. And the other way it really alters is that if you think about, let's say you have children, but they're not all the same financially prudent, let's say, or let's say one has special needs where the other doesn't. Oftentimes in the past, a trust would be set up so that, let's say I pass on, Nancy's gone, we're both gone, and the money goes to an inherited IRA, but the distribution of those funds are governed by a trust where maybe it distributes the income over lifetime because you're trying to protect the principal for a child maybe who has special needs and also has needs Medicaid protection, or for whatever reason, we've talked in the past in some podcasts about alcohol or opioid dependencies where you don't necessarily want a lump sum of cash going to somebody because it'll harm them more than help them. All those plans have to be reviewed and revised because of this new rule also. So some of the more complicated advanced planning we've done with clients, with attorneys, they really all need to be re-examined and retested.
Yeah, and here's the thing. I'm sorry, but it's your job, Tim, and a good fiduciary's job to make sure everything's done in the best interest of your client. Congress doesn't care. I'm sorry. Right. The Congress doesn't care about the individual when it comes to what their specific needs are. They look at one couple with a couple kids and they think they're the same as the next couple with a couple kids, except for, like you brought up, one of those children is special needs, or one of the children from the other couple has some drinking issues or some dependency issues. Congress doesn't even care. They just think, okay, bottom line, how do we get our tax money? And they'll pass the rule, which they think is best for everybody, which absolutely does not fit everybody. So I think it's vitally important.
Yeah, and so if you are, a lot of people will have like I do, my primary beneficiary is Nancy, my wife. That really doesn't change at all. But what really changes is how the next generation receives the wealth, how the contingent beneficiaries, the children, especially if they're minors. So there's specific rules. If they're minors, they can still get some of the benefits, but then once they reach the age of majority, they have the 10-year rule. They really created very complicated rules. But the other part of it, I think, where it really impacts and it is, again, getting back to the either disabled or chronically ill or dependent or just other special needs, all those plans really need to be reevaluated. And that's kind of our primary focus in the first quarter of this year then.
I know that you're doing that for all your clients, Tim, but if somebody has a plan and maybe their advisor just hasn't reached out to them or they're not as active with their clients as you are, is there a way that somebody can come in and have you review their plan from a different advisor?
Yeah, we have what we call kind of a discovery meeting or discovery process. And typically one of three things happens. We meet, we gather the information, we meet again to do the analysis. And the worst thing that can happen is we come up with some ideas that they can then provide to their existing advisor to implement. Mm-hmm. Or maybe the second thing that might happen is everything they're doing is perfect. They have a great advisor, in which case we tell them, keep on going. You're doing great. And then the third thing that might happen is maybe they identify some things that they could be doing that they're not doing with their current advisor, and they may want to, consider working with us. So, but at the worst case is they get some better information that they could use to update their plan.
Yeah.
For example, one of the things that we're just digesting it, but we're incorporating into our stress test to talk about maybe converting IRA dollars, traditional IRA dollars, to Roth IRAs over lifetime, maybe contributing more to the Roth 401k and IRAs over your lifetime, because some of these changes don't impact the Roths, but where they really dramatically impact the traditional. So that's just one example. Or we're starting where, when you're 70 and a half, or now I'll get into that, they extended the rule to making required minimum distributions out to 72 now. But for those people taking those required minimum distributions, we're kind of focused more on, in the stress testing and in the planning analysis, determining whether they should be doing more charitable contributions with those dollars versus other dollars. So those are just two examples of some of the different ways we're looking at these new changes.
Yeah, a lot to unpack.
Yeah. But beyond the stretch IRA, I just wanted to also go over just a couple other changes that were included with the Secure Act, because I think they're important. A couple of, some of them good, some of them are just not really sure about. But for 529 accounts, so we have a lot of clients who have used 529 college savings accounts. They're wonderful vehicles to get tax credits or tax deductions as you contribute. You can use them the funds tax-free if they're used for room, board, tuition, depending on the plan. In the past, withdrawals were not allowed to be used for student loan payments, but they did add a provision in the Secure Act which allows for up to $10,000 to be withdrawn from their tax-free, to be used for student loan payments. So I thought that's a pretty good feature and a pretty good thing that we're going to try and get out to some of our clients who have those for their children, but also for their grandchildren.
Yeah, absolutely. That's great.
The other thing they did was, I guess, in return for knowing that they're going to collect tax revenue faster, by making people take money out over 10 years versus lifetime, they did extend the age where you have to start making withdrawals. So under the old rule, in the year that you turn 70 and a half, the IRS has tables, and we use those actuarial tables to calculate a required minimum withdrawal that they have to make. They've pushed that age back to 72. So again, this will impact some of our clients who are approaching it. Now, some still may make the withdrawals, but for those that don't want to, that's part of the equation now. So we can maybe look at deferring that. And I mentioned before that, I have one client in particular. He has required minimum distributions every year, and he's got a pension that he receives, and he doesn't need the required minimum distributions that he's being forced to take out. Mm-hmm. So what we've done for him is we've set up a plan to take those required minimum distributions and process, and he has like 12 or 13 of these direct transfers to the charity. He has 12 or 13 different charities that he likes to provide for his church, Boys and Girls Club, YMCA, a couple others. And we're helping him process these required minimum distribution directly to the charity. They did keep that provision with the Secure Act. And the only thing they really changed there was they said, now because required minimum distributions aren't required till 72, for those who are 70 and a half and not 72 yet, they said you can still do it, but only up to $100,000. So I'm probably, again, digging too deep into the woods, but this is another area where we're updating and changing and revising some of the plans we have with our clients who are facing these issues.
Well, yeah, and you say that you may be, getting into the weeds a little bit or getting too deep into the woods on this, but honestly, what you're doing for me is you're showing me that there's a lot of little things in the Secure Act that people just need to be aware of it. And like we talked about before, each person's situation is different and unique. And so I think you're hitting good points on, for multiple people that are listening to this podcast, there's going to be something that perks their ears up and say, oh, well, you know what? I probably need to take a look at that. So I mean, I'm not in that position where I have to worry about the RMDs and,
Right.
all that cash that's going to go to charities at some point, but I'm sure somebody is, and they need to be listening to this very closely.
Yeah. And another area is we have more and more clients who they don't really fully retire. Maybe they leave the career, maybe they leave they sell the business. They exit the more stressful part of their life, but they want to continue to doing something. And oftentimes that work flow, whether it's part-time, full-time, goes beyond age 70. And in the past, you were not able to contribute to IRAs or continue adding money to them, beyond a certain age, and they've changed that. So long as you have earned income, a lot of these situations are where the client wants to continue working, maybe doesn't necessarily have to need the money to do it, and would like to continue building the retirement account by adding more money to it. They're allowing you to do that now after age 70 and a half, where in the past, once you reached age 70, the year when you turned 70 and a half, you could no longer contribute. So I actually think that's a really good thing, because it really does allow for our clients to continue funding and pushing money out into the future for the next generation.
Well, and that's something that, I don't know if this is the right way to say it, but kind of has a trickle-down effect, because being able to change just that one piece is going to affect a lot of other pieces of the planning.
Mm-hmm. Absolutely. And then one just other final piece that I think is important to get out there, and I think it's a really good thing. It's not a big number, but they are allowing now up to $5,000 to be withdrawn from retirement accounts, 401ks, IRAs, etc., that can be used for the cost of a birth or adoption, and you can make the withdrawal without penalties. So that's definitely something that wasn't there before, and I think that's something that I've had a number of clients in the past where their children or grandchildren, are looking for, they're gifting funds to help with those things. This is also now just another way to get money out.
So you're saying that a parent or grandparent can pull it out of their account for their child to be able to adopt?
Yeah, we believe so. Again, we're still trying to digest the details, but that appears to be the case, yes.
Wow, that's great.
Yeah. And I'll just give you just a quick example. So I have talked to one client about these changes already. And so under the current plan, when they pass, the money is going directly to his spouse. But as we looked at the way the changes in the law work, they have a disabled child who needs to get the assets protected for him. And so one of the things we're going to do is we're going to change the beneficiary so that it doesn't go directly to his spouse. It goes she basically disclaims it, and it goes directly to the child, because there's benefits to a disabled child who receives an IRA, whereas if they become a contingent, they don't. I know I'm probably not being clear enough, but the point is that it's a complicated rule. And in this case, we were able to respond quickly to make it so that this child who needs funds protected from Medicaid and from to basically asset protection, tax protection, couldn't get it unless we did this disclaimer up front. So we're in the process of implementing that already when the law just changed on December 20th. So it gets back to my point at the beginning that this is really an impactful change, and a lot of people are hearing about it. And I just wanted to make sure, we quickly got information out as quick as possible.
Well, and again, I mean, a couple of things that you just spoke about don't affect me personally, but it, again, like you said, it harkens right back to the fact that there are a lot of changes, a lot of little things, and some really big changes that will affect everybody's plan out there. And I think that each person obviously each person you're working with, you're going through it again and re-stress testing and doing all that for your clients, which is fantastic. But again, if somebody's listening to this and says, some of the stuff that Tim was talking about went right over my head, I have no idea. But I did hear, a couple things that may affect me. I know that you already kind of broke down how it could play out, but the first step is giving you a call and make an appointment with your office. So please give us the number again, so people can reach out directly to you.
Yeah. So my direct number is 219-246-5370. My email is tscannell@hightoweradvisors.com. And we have a number of resources that we have on the website. You could also access at hightoweradvisors.com. And you can also Google Hightower Great Lakes. And again, I think a number of people are going to want to look at Roth conversions. If you're considering passing IRAs to your kids, you want to re-examine that. If you're considering, IRAs to charities, or in some cases you didn't plan on spending down your IRAs, you may want to consider doing that now. So there's just a number of things you need to consider, and we could certainly help you with that.
Fantastic. Anything else? Any closing thoughts for today?
No, just make sure that you re-examine all of your plans, especially if trusts are involved, and how you're looking at your long-term generational wealth plans as it relates to retirement accounts.
All right. Fantastic, Tim. Thank you so much for your time today.
Oh, thank you.
You bet. And thank you all for listening to the Wealth Stream Podcast with Tim Scannell. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Tim comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at Hightower Great Lakes, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Wealth Stream Podcast. We hope you gained some valuable insight that you can apply to your life and share with others. Please don't forget to subscribe below to be notified when new episodes become available. And don't forget to live greater. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Hightower Great Lakes. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Hightower Great Lakes is a group of investment professionals registered with Hightower Securities LLC, member FINRA and SIPC, and with Hightower Advisors LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities LLC. Advisory services are offered through Hightower Advisors LLC.